Okay, folks, welcome to the week ahead commentary. This is where we review the closing price action for the bond and stock markets, and we talk about our strategy as we move into the new trading week. Let's begin with a position that we put on Friday, which was we purchased a pretty large block of put options against the triple Qs. The trade was a bear put spread, meaning we purchased a deep in the money put option on the Qs and sold a deep out of the money option on the Qs to help finance a portion of the trade. So that way, if we're wrong, we're being compensated by our hedge to offset any of the time decay or any of the losses. So it's not a pure short on the triple Qs, but it's good enough for our purposes because what we saw last week was some real weakness in the markets. We saw PayPal, where we sold naked puts against, that really undercut the bullish reversal bar. We're going to go over the chart in a moment. It undercut the bullish reversal bar that we saw earlier in the week. LABU, the biotech leveraged ETF, closed at the lows of the week. We rolled that trade. Again, we'll talk about that more in a moment. So the strategy behind opening up the Qs is both for protective purposes, because at current, we have reined in our risk exposure and have become far more neutral on the market so that if an event occurs, we are good. And in all probability, will come out of any shock to the markets with a profit. Now, the position I put on was pretty large. I debated just putting on 5 contracts of the short of the Qs. I went with 10. And the reason for that was, A, we were headed into a weekend and we were closing very close to the lows of the week. B, we are seeing the yield curve. And as a reminder, for those who are new, the yield curve has predicted pretty much every recession, perhaps excluding one since 1955. And you can see that for the month of March already, not only have we made lower lows on the yield curve, I mean, we're cratering. We're cratering. This is March. We're only on the 5th day of March, yet not only have we taken out the lows of February, I mean, we're really nearing the inversion of the yield curve. So I would argue that in all probability, we are already in recession because the bond market is telling us, hey, buckle up. It's going to be a rocky road for a while. Add to that, we have absolute morons in Washington, absolute morons over in the EU. They are driving this ship. They're being influenced by the Davos crowd, the World Economic Forum crowd. They have delusions of grandeur of a great new society. And this, I want to be optimistic, but unfortunately, I think things need to get worse before they get better. Now, what if I'm wrong? What if I'm wrong and the triple Qs and the markets rally on Monday, Tuesday for the entire week? That's okay. We have long positions. Right now, our primary goal is not to lose money. And I'm not opposed to taking half of that position off the table on Monday morning. I just want to get through the weekend without having a lot of worries. But we are going to keep a hedge on for the time being. Let's get to the rest of the charts. Okay, so yield curve we went over. It's dropping like a rock. As for yields, the 10-year yield, it's cratering. This is not a sign of strength. This is a sign of weakness in the economy, despite the fact that we had pretty good economic data that came out on Wednesday with the ADP report, and on Friday, it's simply not good enough. We're shedding jobs here in the United States, and inflation is just tearing through the economy. And we have a Fed chairman that's not serious about fighting it. The TLT, the 20-year bond ETF, it closed off the highs of the week, but it's an up week. You're seeing money move into bonds, out of equities, into commodities, where the new bull market is. I'm going to go into some other stocks in a while to show you where the new bull market is. The TIPS Treasury inflation protected securities screaming new all-time highs very, very soon. Volume extremely high. Institutional accumulation. The dollar. So I think that the dollar is going to head up higher. We're probably going to get a blow-off top on the dollar, much as what you saw back here in March of 2016. Once we get that blow-off top on the U.S. dollar and the subsequent reversal bar, you're probably going to see gold, the miners, commodities correct a bit. Why might that be? Well, it's probably because the fear trade has subsided some. Maybe we'll get some good news out of Europe. Tensions will come down. Money will rotate back into high-risk equities. But I think that that's going to be the opportunity to back up the truck on commodities yet again. And we'll keep a close eye on the inflation numbers to see whether or not they're accelerating, flattening out, or declining. And we'll make our decisions from there. We have no predetermined course of action as it stands right now post the top of the U.S. dollar. But this is going to be one of the primary indicators that I'm going to be using for how we're going to be trading in the next year or so. If inflation remains hot and the dollar weak, well, that commodity trade is alive and well. Let's check in with the daily chart. A bit extended on a weekly and daily time frame, but folks, this could rip up higher. Again, we're looking for that blow-off top on the U.S. dollar. And frankly, once we see that parabolic move up higher, we're going to be looking to take shorts off the table. The VIX, I was surprised that this wasn't more of a bullish chart, to be honest with you. We closed up on the week, but we closed off the highs of the week. No breakout. It looks as though the engines are revving here for a big move up higher. But along with the U.S. dollar, if and when we get that rip up higher, we'll be watching for an opportunity to exit any short positions and look to start buying stocks that are deeply oversold. I ran a scan. There was absolutely nothing out there that I saw as being very attractive from an oversold perspective. A lot of bond funds are out there, but we're not interested in that. RSI continues to gain momentum. ADX is very, very overbought, and it's beginning to perhaps put in a lower high here. Mixed messages here. Stokes still very strong. They are rising, implying that we're going to get higher highs. Let's go to a daily chart. You saw some selling of the VIX on Friday. Whether that was shorts covering in advance of the weekend, I'm not quite sure. Ultimate oscillator really weakening up here. MACD histogram weakening up. We may get a rally on Monday morning. I'm torn here. Rally in equities, I should say, just to clarify. The Dow transports. Folks, the railroads are on fire. And you're seeing a potential breakout here on the Dow transports. We closed up on the week, up 1.22%. And this is one of the primary reasons why I didn't go shorting the S&P 500 and went with the triple Qs, because that's more of a pure play on technology and growth. Now, remember what I always like to say about the transports is as go the transports, generally so goes the overall stock market. It may lag, it may take a month, but if we do get a serious breakout here on the Dow transports, which I'm not going to dismiss because the railroads are on fire. They're in fuego right now. One of them is on our watch list. I remember yesterday somebody mentioned the CSX. Sure enough, they came up on our bullish screen today. So let's keep a very close eye on the transports because this is our canary in the coal mine for the S&P 500 and where inevitably it'll probably go. Let's go to a daily chart. Look at this. Really nice price action. Yeah, we were down on Friday, but not all down days are made equal. We were down significantly on Friday, yet we rallied to close back above a breakout point. So to me, I look at this chart, I see a red day on big volume. However, I think it's bullish because it doesn't matter where you trade intraday. What matters is where you close. That's why we don't day trade. That's why we don't go buying stocks willy-nilly in the morning because they're weak or they're strong. What matters is where they close. And the Dow Transports had a very, very serious bullish day on Friday, despite the fact that they closed down on the day. Stokes looking awesome. I like the chart. The Dow Jones Industrial Average weekly chart holding on to support. Stokes weak and getting weaker. So it's really a tale of two markets here. RSI getting weaker. Volume rose last week, daily chart. All right, so next week we're probably going to get a crossover, the death cross or whatever you want to call it. Whatever, it's such hyperbolic talk. The negative crossover of the 50-day down below the 200-day moving average. It's going to be all over CNBC. They're going to talk about it because it makes for a great headline. But after that negative crossover, you may actually get a rally here on the Dow Jones. We did bounce off of support. How was volume? Volume rose to the downside. MACD is pretty oversold. Stokes are rising. The question is, do we close above the 50 mark? Do we close above this resistance level in blue? Let's update this. The S&P 500 weekly chart, we closed down on the week at support, 4,300. RSI continues to weaken. Stokes continue to weaken. No lower low last week. Volume rose. Daily chart. Okay, so it looks as though what we did here is on Friday, we broke a bear flag setup. All right, so we sold off hard, rallied, and what did we do on Friday? We broke that support level. So this is a pretty bearish chart. And while it's great, we rallied off the lows of the session. We closed back above a support level. Great. But we broke in trend, that short-term trend. So the macro trend, the higher level view trend is to the downside. And it appears as though, yet again, we've put in another lower low. Now, while we may not get a negative crossover next week on the 50-day and the 200-day moving average, probably by Monday, Tuesday of the following week, we're going to see that negative crossover. And the headlines are going to be screaming negative crossover on the S&P 500. Again, if it bleeds, it leads, even in the financial markets. And this death cross, as they'll probably publish it, is an equivalent of blood in the streets in finance. So the Dow Jones is one thing. That'll be somewhat significant. The S&P 500 is far more significant when you get that negative crossover for the financial news media. So the bearish buzz is going to remain in the news for the next couple of weeks. So sentiment's going to be bearish. But with that, we need to keep our minds open and say, okay, there's a lot of negative sentiment in the market. Do we have opportunities to identify oversold stocks, reasonable valuations with good setups, and let's start buying when there's blood in the street, just like we did a couple of weeks ago with PayPal, FedEx, IWM weekly chart, a lot of resistance up here at 205. So we broke this bear flag setup the week of February the 22nd. However, we rallied to close positive. That was a buy the news event with the invasion of the Ukraine. But we got no follow-through last week, and we closed out the week with a bearish reversal bar. I'm wondering whether or not we're going to get a negative crossover on, I shouldn't say negative crossover, a lower high on these Stokes. That would be really bearish. I can't overemphasize bearish. I do need to point out that we did break out on weekly RSI a week or so ago, but it appears as though we're not getting a follow-through. Maybe it's a pullback and a retest. Not quite sure yet. Volume, very high. MACD, I gotta say this, is MACD is very long in the tooth here. It looks as though we may get a move up higher on MACD, but that's certainly not being reflected in price. We had that bearish reversal bar. So when you're at a standstill right here and now, and you're making a debate about what's right, the indicator or price action, you always side with price and volume action first before you side with your indicators. So in this case here, I'm going to have to side on the bearish side, despite we're seeing some possible bullishness on the indicators, because price, we were down and we closed into the lows of the week on big down volume. How do we interpret that? Institutional distribution, end of statement. All right, trip Qs, weekly view. So here you have it. Bearish key reversal bar. We made an effort to try to recapture or break out above this upper band of resistance in blue and the horizontal line in green and red, but we were rejected. Stokes, I don't like. I don't like this at all. RSI, lower lows, lower highs last week. Volume, institutional distribution, daily view. And then I want to take a quick peek at the monthly view. Here's a break yet again, just like with the S&P 500. We had a bear flag setup created, and we broke that support level. Now, I'm modifying the Stokes because I want to see whether or not we are able to break out to new higher highs. RSI is concerning in that we have a rounding top below 50 on RSI, which is pretty weak. So the daily chart is screaming more weakness as we proceed into the new trading week. Now, they did announce a ceasefire, I believe I read. As a matter of fact, I'm not just following the U.S. news. I'm balancing it out with RT. This is the Russian news network. Let's just refresh this. I haven't checked this at all today. Oh, look at this. They blocked it. Isn't that something else? They blocked it. Let's see if I can get on the Russian version. Incredible. I know they closed their U.S. operations. RT News. This is so incredible, man. This is the information war. We think that we're not in this war. We are in this war. We are in this war. Okay, I don't want to waste people's times here. It's very disappointing that we can't get the news that we want in this day and age. Okay, continuing on. The fact that I can't pull up any news organization I want to, that level of censorship, whether it be RT Russia, RT US, granted the US version may not be available, and maybe I'm not pulling up the Russian version of RT News correctly. The fact I can't access it quickly is very, very disturbing and does not bode well. You have a free market, you have a free and open society. I believe in that wholeheartedly. You try to manage a society, better than the people that invaded Ukraine. Moving on to the banks. The banks, our short position on the banks expired worthless. We sold options on the banks. I didn't roll the trade or open up a new round of trades because I shorted the queues overall. And there are banks in the queues. So I didn't want to get overly short. So a pretty bearish week on volume. Let's go to the daily chart. If I take some of that queue position, and I really don't know off the top of my head what the ratio is of banks in the queues. But if I do take some of that queue position off and we see an opportunity here to sell more naked calls on the queues, we'll do that. But right now, I'm looking at these Stokes. They're hooking up. We're at the lows of a trading range. RSI is very weak. Down volume was heavy, but a lot of that was buying on Friday. So I'm kind of happy I didn't roll that position. So at current, we have no short position specifically on the banks. Technology, weekly chart, very bearish. Bearish reversal bar down nearly 3%. Stokes, no lower low, I don't think. Very close, though. It looks as though we may have just by a tick or so. Volume was heavy, daily chart. RSI, that rounding top, much as what I pointed out on the Qs. Bear flag break setup broke down on Friday. Volume pretty heavy. I shouldn't say that. It's below the moving average, but it rose versus Thursday to be accurate. MACD very, very weak. Really weak. The semis broke weekly support. Head and shoulder setup. Left shoulder, head, right shoulder. The semis are in trouble here. Look at the Stokes. They pushed to a new lower low. I know Twitter right now is screaming about NVIDIA, whatever setup they have there. I know they were holding a support level. Let's check them out, how they closed out the week. Down 5% on the week. I love NVIDIA, but I'm not loving the setup here. We have a lot of resistance up here. The market's just telling us that. Daily chart. Yeah, I don't like this at all. We were holding support, but we broke it on Friday. Energy. Weekly chart. Very powerful week last week. Up over 9%. And it looks as though it's going up higher. Daily chart. It's extended. It's going to correct. Can it move up higher? Absolutely. RSI is at current 75.79. We've been higher before. And we don't want to get lured into the short camp on the energy space due to the third standard deviation Bollinger Band being flirted with. All it need to do is trade sideways for a day or two. Then all of a sudden, it could rip up higher yet again. So we're not looking to trade a, air quotes, overbought condition on energy. Volume very high under institutional accumulation. We can't fight these guys. That's stinking thinking, and we will get burned. Natural gas, up nearly 20% last week. And it looks as though it's going up higher, on volume no less. Massive accumulation. Let's take a quick peek at the monthly view. Yeah, higher lows. It looks like we're setting up for a continuation breakout. We need to consider putting a trade on Boyle, whether it be selling naked puts. Definitely don't want to sell a naked call to offset that naked put, because this thing could really rip your face off, and we don't want to be involved with having to defend a naked short position on a commodity, no less, because it could take up a lot of your time, cause a lot of anxiety, and the last thing we need right now is to be trading with us being on our heels rather than on our toes. So we're not going to be looking to put on a hedge if we decide to get long of natural gas daily chart. And I guess what I'm trying to say here is I'm worried about a crash up on Boyle. It's a better way of putting what I'm trying to articulate. Worried about a crash up here on oil and on natural gas. Daily chart, we're still trading down below the 200-day moving average. It's really surprising. It's like there's a lag here on natural gas. Oil, no lag here. A huge move last week, up over 20% in a week. And this is not a leveraged ETF, folks. Think about it. Boyle is an ultra leveraged ETF. It was up 25%. Oil is not a leveraged ETF, up over 20%. That's scary stuff. And it looks like it's going up higher. Look at the volume. Daily chart. It's very extended. I'll grant that observation, but we were extended here, here. And this is what I mean. All you need to do is trade sideways for a day or two. Like over here, pull back, rip up higher. So these dips, you have to assume they're going to be bought. So we're not going to be looking to short oil on an overbought basis. Not with the news cycle the way it is. The news cycle is very, very negative right now. And it can get a lot worse. Emerging markets. So they're rolling over. There are certain countries that are doing well. Indonesia, I'm going to go to that one in a moment. Indonesia is doing well. Brazil, doing well. Now, the EDC, this is 30% China. So while I think there's going to be an opportunity here in the future, and I know I scream about don't buy Chinese stocks. This is not individual Chinese stocks. So that's why I entertain it using a fund. And it's not 100%. It's not a pure play on China. So yeah, I'm rationalizing a bit because it's optionable, to be honest with you. So we closed down below support. We're probably coming down here to $50 a share. So I would not go buying yet because I think we're going to get lower lows. We broke down on RSI, broke down on Stokes. Avoid right now anyway. Gold. Gold had a great week, up over 4%, and it's going up higher. Stoke, we've been talking about. This is no great shock. This is for the benefit of those that are watching this next week on the replay. We've been into gold for a while now, and not necessarily gold. Let me rephrase so I don't get called out. We don't own any gold. We own the gold miners. When you buy gold, you're looking for a store of value. You're not necessarily looking to make a profit. But when you buy the miners, that's how you're looking to capitalize and make a profit on the gold trade, because the gold mining stocks tend to outperform gold. And we'll go to the percentage gains on the miners versus gold for last week in a moment to illustrate that point. Now, gold on a monthly time frame at current, we haven't put in a new monthly higher high yet, but we're going to. Daily chart, nice little orderly consolidation in here, and it just blew up on Friday. So, you take a look at price action on these safe haven commodity plays, a flight to safety, and it certainly influences whether or not I wanted to put on a short trade of the triple Qs. So let's recap for a moment why we did what we did. And this doesn't mean I'm right in the trade. We don't know yet. But I at a bare minimum, needed to put on a safety net. Because what is the market telling us? Well, we went over the yield curve. Yield curve is screaming recession. We talked about the breakdown on the 10-year yield. Generally, that's bullish for growth stocks, but in this time around, it's not, because money's rotating out of stocks and into the bond market for safety. The technicals on the triple Qs, the S&P 500, they broke a bear flag setup. And as we arrive to gold, which is a safe haven play, it's rising with the US dollar. that is a clear geopolitical risk on event for commodities, risk off for equities. Therefore, we want to be long of these names and we want to have a protective hedge on our portfolio. And that's why we open up a fairly significant position on the TripQs. Now, going on to our positions, keep in mind you had gold that was up 4.19%. The GDXJ, which is our investment in the miners. We have investments and we have trading vehicles. GDXJ is our investment vehicle because it doesn't have time decay like NUGT. It was up twice as much as gold was, up 8.5%. Very close to a breakout here. It's definitely a continuation move. And when you take a look at it from a monthly time frame, while gold hasn't put in, it's close, but hasn't put in a new monthly higher high, GDXJ has. And there's a lot of room in this tank to move further. Now, moving on to our trading vehicle, NUGT, we'll trade in and out of this. It was up nearly 18% on the week last week. Now, I did sell naked puts on NUGT. Those expired worthless. So 100% profit there. 100% profit on our short of the banks using naked calls. NUGT, a clear and defined breakout last week. We are trading up and into the third standard deviation Bollinger Band. Maybe we'll get a little bit of a retrace on Monday, Tuesday. But I think ultimately this chart is going to get resolved to the upside because there's nothing not to like here. Volume, strong. Gold money, we were up 7% last week on this trade, and it broke out on a weekly time frame. This could be bought. Our silver miners, up over 9% on the week, a clear breakout above resistance and the 50-period moving average on a weekly time frame. This is technically significant. We haven't closed above, I should say, the 50-period moving average since here, June of 2021. Look at the volume. This is not mom and pop buying 100 shares. These are institutions accumulating the shares. Daily view, daily chart, very strong. Did we close above 14? Yeah, we did. We eked out a gain. Good. It's good to see we close above 14. On volume, no less. Good stuff. Our position in silver, weekly chart, up over 12% on the week. It too closed above its weekly 50-period moving average. Stokes are rising, RSI are rising. There's nothing not to like here. Volume heavy, daily chart. Daily chart strong, a little bit of resistance at $42 a share. That is the pivot point, folks, of this W formation. So if we close above $42 per share, that's a significant breakout on silver. Cal-Maine Foods weekly chart. This is our little egg company. Food products doing well. Why are we still involved with it? Not for the daily chart, not for the weekly chart. It's for the quarterly chart. Look at this breakout. The longer the consolidation, the greater the validation of any breakout. And we have a multi-year consolidation. Monthly chart, new monthly higher highs. We're going to remain long here. Weekly chart, up 2% on the week, on volume no less. Daily chart, strong day on Friday, up 1%. Volume rose, very nice. Moving on to PayPal. PayPal had a very rough week. So we had sold naked puts 103 strike, but that strike failed to hold, and we closed down below $100 per share. And we had a bearish reversal bar on the week, implying that we're probably going to go lower. Now, what we did here was I did roll out that 103 strike to another week. The however is that I wanted to minimize any event, any collapse or crash in the market. So rather than taking 100% of that premium and saying, okay, I'm going to hope that we do not crash and in essence stay net long of PayPal, I took a portion of the premiums that we were paid to roll that trade out, and I bought put options. So that way, if there's a heavy correction in the stock market next week, if God forbid we wake up on Mondays, which happens to be a very historically bearish day, because those who covered shorts are looking to put them back on Monday morning. They cover them on Friday, put them back on Monday morning. So just in case we gap down, we have a floor at $93 a share, and we're still collecting a premium. So the worst that we can lose on this trade is the spread between 103 and $93 per share, and you got to deduct the premiums paid, and that's our max loss on PayPal if it happens. So we're hedged here. Now LABU, a slightly different situation. LABU has corrected so severely that while I hedged the position, I didn't buy puts because I'll just take the shares. So what we did do is we rolled the 16 strike, the naked put 16 strike. The however is that we hedged that position somewhat by selling a 16 call. That's called a straddle. We have straddled the 16 strike. So a minor hedge on LABU. But it looks as though on a weekly time frame, it's probably going to go lower because we closed at the lows of the week daily chart. Now, LABU is looking really good with this cup with handle formation, which is why I opened up the trade, to be honest with you. If we close down below 1255, we're going to have to close out the trade because that means we're going to single digits easily, and I don't want to be involved with that. Let's talk about some of the positions that we're watching, stocks that we're watching. Union Pacific Railroad, weekly view. This is a clean breakout. Any pullback next week is a buying opportunity. Look at the volume, institutional accumulation. I posted an article in the Slack forum out of Investors Business Daily this morning because I wanted to make sure that I understood the whys behind this rally. And one of the main reasons is that the railroads are less fuel intensive than what are trucks, making the transport of commodities, any goods whatsoever, more favorable towards the railroads. And that's why you're seeing them rally. So go to the Slack forum. Under the Stock Market Observations tab, I posted that article out of Investors Business Daily. ITA, the iShares Aerospace and Defense ETF. This was a watch stock from last week. We expected a breakout. We got the breakout. This appears ready to be bought. We did sell off the highs. That's a bit of a concern, daily view. But I think the risk reward is favorable in that if we buy on Monday morning, assuming where we closed on Friday at 109.33, we buy there, where would we place our stop? Well, if we close back down below 107, because that would be a breakout point failure, technically very bearish. So we have a clear and defined stop loss point, and it sure as heck beats what we could have done, which was chase these shares up higher, which we never ever do. Mlpx, weekly chart. This is another one we spoke about last week. As a watch stock, it broke out last week. Volume very heavy. Institutional accumulation. This is probably going up higher. Let's go to a daily chart. Daily chart, beautiful chart. I can't chase this though. It's got to come in a little bit. Look at the volume. Institutional accumulation. Energy, another watch stock from last week. It broke out on a weekly time frame. Daily view. Yeah, we can't chase it here, but certainly these are certainly positions where we consider opening up strangles on. This is where we want to be. This is where the new bull market is. I have other stocks I'm going to bring up in a moment as well. Now, Indonesia, we've been watching for quite a while now. And whereas you saw the EDC, which is 30% China, very weak last week, IDX was flat. And we have a breakout on a weekly time frame. This could be bought. Daily chart. So we had a breakout point failure. We broke out here, closed back down below it. That's why we avoided it. Popped up higher on Friday. This is a screaming buy. Indonesia. We're probably going to be long of it on Monday. Now, other stocks that are out there that we're going to be watching to put on. Copper. United States Copper Fund. A bit extended. It's got to come in a little bit, but this is a clear and defined consolidation, a W formation. And what do we do on Friday? We closed out the week above the pivot point of the W formation. Is your left side pivot point, right side breakout. This could be bought. The however is that we need to be very, very careful. Why? Daily chart. It's very extended. Shorts are getting their faces ripped off. And this goes back to what I was talking about with natural gas. Why do we not want to open up a naked call position? Because you can get a crash up. This, folks, is a crash up. Look at the percentage gain on the week, 8.97%, nearly 9% move, and it's been consolidating. You know darn well that the implied volatility was probably pretty low, so that if you sold naked calls, you weren't getting paid much. It would have forced you to stay close to the money, and in all probability, you're underwater on that trade, not where you want to be, because all this needs to do is correct for a couple of days, and if you don't cover, take your loss, you're going to get another leg up, and it's going to be ruthless. Commodities, currencies are extremely ruthless. Be very, very careful about having naked call positions because they're not as cyclical as our stocks. They're more secular in nature, meaning longer term price moves. Other names we're watching, XLP, consumer staples. Here's the XOY, right? Tale of two charts. XOY getting hammered. I've been saying for weeks now, avoid consumer discretionary. Why? What's a staple? Energy, food. People need to buy those first before they go to Starbucks and throw down $6 on a latte. So XOY, avoid. XLP is a buy. We're beginning to show signs of a continuation breakout here. Daily chart. Look at this beautiful price action on Friday. No breakout, but we're very, very close. Look at the volume. Very nice. Other names, Avalon Bay. This is real estate. Weekly chart. We broke out last week. And if you want a yield, it pays over 2.5%. And plus you have upside potential. So you're getting paid to wait. Verizon, another one that's yielding 4.6%. And it's beginning to break out. And you have a very long term. Let's go to a monthly chart. A very long term. Let's update this. Consolidation. And as I mentioned with Cal-Maine Foods earlier, the longer the consolidation, the greater the validation of any breakout. This thing's been consolidating since 2018. And when it breaks out, look out above. So this is one where I'll probably buy it and throw it into my long-term portfolio of just investments and sit with it. They're just throwing off cash and they're paying it out to investors. And that's it for this week, folks. I'll catch you on Sunday Night Futures Live. Until then, enjoy the remainder of your weekend. Be well.